In today's video, I'll be revealing the critical tax planning window that opens at age 60 and why missing this brief opportunity could cost you tens of thousands in unnecessary retirement taxes. If you're new to the channel, hi, I'm Julia, certified financial planner, and through analyzing hundreds of retirement tax returns and identifying the exact timing of tax savings opportunities, I've discovered that the years between 60 and 68 represent a unique tax planning sweet spot that most financial advisors completely overlook. And that's exactly why I'm making this video today, to show you the specific tax strategies that become available at age 60, why this limited window closes rapidly as you approach Medicare and Social Security eligibility, and how implementing these strategies now can dramatically reduce your lifetime tax burden. So let's get into it. The first one doesn't apply to 60-year-olds, but it does apply to those 62 and older. As we all know, the One Big Beautiful Bill Act passed in July of this year, and it established a temporary senior deduction available between tax years 2025 through 2028. This deduction allows taxpayers aged 65 and older to claim an extra $6,000 or $12,000 if you're married filing jointly, on top of the standard deduction and on top of the blind or over 65 deduction of $1,600 each. There is a phase-out at modified adjusted gross income of $75,000 for singles and $150,000 for joint filers, and it is fully phased out at $175,000 and $250,000 respectively. The phase-out rate is 6% of income over the threshold. And this is excellent news, as it means that these seniors have larger below-the-line deductions, and this results in less taxable income. However, it's important to understand that this is a below-the-line deduction. So it will not reduce adjusted gross income for purposes of adjusted gross income-based limits like Medicare IRMAA limits or ACA tax subsidies, Social Security taxation, net investment income tax, etc. However, this senior deduction still matters for Roth conversion planning, even though it doesn't directly affect adjusted gross income. Let me show you what I mean. Let's say that Mark and Michelle, both 65, have a combined adjusted gross income of $100,000 and take the $31,000 500 standard deduction. In 2025, they would be taxed on $68,500 of income. However, under the new bill, they get to add an extra $12,000 to their $31,500 for a total deduction of $43,500. Therefore, instead of paying tax on $68,500 of income, they'll pay tax on $56,500 of income. If they're in the 24% bracket, that's a tax owed reduction of roughly $3,000. Because the senior deduction widens the room you have within your current tax bracket, you'll be able to convert more than you could last year before hitting the next tax bracket, or you can convert the exact same amount as last year but pay less in tax. This strategy is especially powerful in the 12% or 22% brackets, where small shifts in income can save thousands over time. Let's look at an example together. Let's say that Dave and Linda are both 66 and filing jointly in 2025. Their adjusted gross income is $98,000, and they're planning to convert $25,000 from their traditional IRA to a Roth IRA. Without the new senior deduction, they'd receive the standard deduction for seniors, which includes the $31,500 base deduction plus $1,600 each for being over age 65, for a total of $34,700. This reduces their taxable income to $63,300 before the Roth conversion. Adding the $25,000 conversion brings their taxable income to $88,300, which keeps them just below the top of the 12% tax bracket. Now, that's solid planning. But with the new senior deduction, they qualify for an additional $12,000, bringing their total deductions to $46,700. Now their taxable income before the conversion drops to $51,300, and when they add the $25,000 conversion, their taxable income rises to just $76,300, which is well below the 12% bracket ceiling. This gives them nearly $11,000 more room in the 12% tax bracket. So they could convert up to $36,000 instead of $25,000 and still stay in the 12% bracket. Alternatively, they could stick with the $25,000 conversion and owe nearly $2,000 less in taxes thanks to the expanded deduction. Even though the senior deduction doesn't reduce their adjusted gross income and therefore doesn't help with the things I mentioned earlier, like Medicare IRMAA, it does lower their taxable income, which allows them to convert more to Roth at lower rates. For retirees trying to reduce future RMDs and smooth out lifetime taxes, this senior deduction is a big deal. Every dollar counts. Next, let's explore why your tax plan must account for more than just your marginal bracket. Coordinating Roth conversions with adjusted gross income is one of the most important and overlooked aspects of retirement tax planning. For successful 60-year-old retirees, it's not enough to simply fill up a tax bracket. True efficiency comes from understanding how various adjusted gross income thresholds interact with your broader financial picture, and how crossing certain lines can trigger unnecessary taxes, surcharges, and lost benefits that erode the value of your strategy. Controlled Roth conversions must be tailored to stay within optimal marginal brackets, typically the 12, 22, or 24% range for most retirees. But beyond marginal brackets, retirees must also manage their AGI to avoid breaching critical thresholds, such as those that trigger Medicare IRMAA surcharges or ACA subsidies. For example, if a married couple's modified adjusted gross income exceeds $212,000 in 2025, they move into a higher Medicare premium threshold in 2027. This can result in combined increases of $2,000 to $3,000 per year in healthcare costs. To prevent these kinds of penalties, successful advisors and retirees use sophisticated software to map out all sources of income, including Social Security, interest, dividends, capital gains, and required minimum distributions, and layer in Roth conversions in a way that keeps total income below key AGI thresholds. They often convert just enough to maximize their current tax bracket without spilling into IRMAA, ACA subsidy cliffs, or the net investment income tax threshold. This level of planning helps ensure that each dollar converted provides the greatest long-term benefit at the lowest possible cost. Uncontrolled or overly aggressive Roth conversions, especially in the early years of retirement, can easily push AGI above critical thresholds such as the top of the 12% or 22% tax brackets, the Medicare IRMAA surcharge limits, or ACA subsidies. Once you cross these lines, the costs aren't just temporary, they stay with you into your future. For example, triggering a higher Medicare premium by exceeding the AGI threshold means you'll pay elevated premiums for the entire year 2 years from now, right? So in the future, regardless of whether your income drops later. And if your conversion strategy pushes you into successively higher IRMAA brackets, these surcharges can compound every year. Now that you understand these Medicare considerations, watch my free training by going to the link in the description, and I'll show you my exact system for building your dream retirement plan given your situation. Okay, let's move on to an overlooked aspect of retirement tax planning, which is coordinating your Roth conversions with your Social Security filing ages. For many 60-year-olds, the default move is to delay Social Security and aggressively convert to Roth IRAs in the meantime. But without proper coordination, this can backfire. The issue is that once you start claiming Social Security, your benefits can become taxable depending on your provisional income. Provisional income includes your adjusted gross income, plus half of your Social Security benefits, plus any tax-exempt interest. And if that number exceeds $25,000 for single filers or $32,000 for married couples, up to 85% of your Social Security benefits can become taxable. Many retirees unknowingly trigger this tax by continuing Roth conversions after they've already started claiming Social Security. And when conversions are layered on top of Social Security benefits, again, they inflate that provisional income and cause your benefits to be taxed unnecessarily. And this creates a form of double taxation, right? Not only are you paying tax on the converted amount, but you're also increasing the taxability of your Social Security benefits. For example, consider Jim and Karen, both age 67 and recently retired. They've just started collecting a combined $40,000 in Social Security benefits and decide to convert $50,000 from their IRA to their Roth. Their adjusted gross income becomes $50,000 from the conversion, plus half their Social Security benefits, so $20,000, so that totals $70,000 in provisional income. This pushes them well beyond the $44,000 threshold for married couples, meaning that 85% of their Social Security benefits, or $34,000, will now be taxed in addition to the $50,000 conversion itself. Had they instead converted a year prior while living off of cash savings and before starting Social Security benefits, their provisional income would have been much lower and their benefits would have remained tax-free. The better approach is to complete Roth conversions during the gap years between retirement and the start of Social Security. These are often the lowest income years you'll ever have, so it's very important to take advantage of these. By converting before Social Security starts, you reduce future RMDs and create a pool of tax-free income without making your Social Security benefits taxable. And when done strategically, this timing coordination allows you to capture the full value of the Roth conversions while keeping your Social Security income protected. It prevents surprise tax bills, preserves more of your retirement income, and helps you stay in control of your long-term tax picture. Next, let's talk about the power of Roth conversions in your early 60s and why waiting rarely pays off. Roth conversions in your early 60s are not designed to save taxes today. In fact, they always increase your current tax bill. However, we consider these to avoid larger tax issues later in retirement. Once you turn 73 or 75, depending on your year of birth, the IRS requires you to begin taking required minimum distributions from your traditional IRAs and 401ks, any pre-tax account. These withdrawals are fully taxable as ordinary income and can obviously raise your income by quite a bit. As we've outlined a few times already, this forced income can push you into a higher tax bracket, increase your Medicare premiums, and cause more of your Social Security benefits to become taxable. It can also expose you to the 3.8% net investment income tax if your income is high enough. By converting some of your traditional retirement funds to a Roth before RMDs begin, you move that money into an account that won't be taxed later. Roth IRAs are not subject to required minimum distributions, and qualified withdrawals are tax-free. This means that you can reduce the size of your future RMDs and keep more control over your taxable income. As mentioned earlier, the temporary 2025 to 2028 window created by the One Big Beautiful Bill Law includes a senior deduction of up to $6,000 for individuals or $12,000 for married couples over age 65. While it doesn't reduce your AGI, it does reduce your taxable income, allowing you to convert more at a lower rate than you might otherwise pay. If you delay conversions until after RMDs start, you have way less flexibility, right? This is really never the option. The required withdrawals must happen each year, and they limit how much you can convert without stacking your income and pushing yourself into higher brackets and IRMAA limits, etc. Waiting also gives you fewer years for the Roth account to grow tax-free, which is kind of the whole point, right? That makes the upfront tax a lot less worthwhile. If tax rates go up in the future, waiting will also save you, obviously, more, right? Or waiting to convert will have you converting at higher rates. David and Lisa are both 66 and recently retired. They have $2.2 million in traditional IRAs, $250,000 in taxable accounts, and plan to claim Social Security at age 70, which will provide a combined $60,000 a year. If they take no action, their IRAs are projected to grow to roughly $2.9 million by the time they turn 73. Their first year of RMDs would be about $110,000, and combined with Social Security and interest or dividends from their brokerage account, their adjusted gross income would likely exceed $230,000 per year. So this will likely put them over the Medicare IRMAA surcharge limit, so they're going to be paying $1,000 or $2,000 more just because of their R&D, right? Which they are forced to take even if they don't need the money. Instead, David and Lisa begin converting $90,000 per year from their traditional IRAs to their Roth IRAs between the ages of 63 and 68, taking advantage of the 2025-2028 One Big Beautiful Act window. During these years, they live on cash savings and the taxable account withdrawals to keep their AGI below the IRMAA first-tier threshold. They use a $12,000 senior deduction each year to reduce taxable income, allowing much of the conversion to remain within the 22% tax bracket. By the time RMDs begin, their IRA balance is significantly reduced, which keeps their future taxable income and their IRMAA exposure lower. They've also built a Roth bucket that they can withdraw from tax-free and higher income years without increasing AGI. In short, by acting early, David and Lisa avoid triggering Medicare premium surcharges, reduce their RMD burden, and gain more control over their tax bill in their 70s and beyond. Lastly, let's explore how preserving a legacy is far more effective starting at age 60 than age 70 and beyond. The very best legacies are tax-free, and they're best given through Roth IRAs. So let me explain. Life insurance proceeds are great because, like a Roth, you inherit them tax-free. But after you inherit those life insurance proceeds and invest that money, the gains, interest, dividends are all taxable to you, right? Whereas when you inherit a Roth IRA, you have 10 years to grow that bucket of money before you have to empty it out, of course, tax-free. So it allows that tax-free growth for longer. So when you take the time to do Roth conversions, it doesn't just help you in the future with taxes, but it does help expand your net legacy and thus help your heirs. Okay, now that you understand the critical tax planning strategies available at age 60, you can implement these approaches to dramatically reduce your lifetime tax burden and maximize your retirement income before this unique window of opportunity closes. If you're looking for more help with your retirement plan, watch my free training by clicking the link in the description. In this training, I'll walk you through the exact strategies to optimize your retirement plan given your situation. I'll see you next time.